Investing entails risk. But what is risk? Is volatility a good measure of investment risk? And finally, does taking on more risk translates into higher returns automatically? These are the questions I will tackle in this video. Let's start right off the bat and define risk. Risk, according to Howard Marks and other prominent investors, is the probability of a permanent loss of capital. By probability, I mean that there is some chance that you will lose your capital. And permanent means that it cannot be undone. Howard Marks wrote 2 memos on risk and dedicated 3 chapters to risk in his prominent book called The Most Important Thing. Actually, it's my most favorite book, and I highly advise, if you haven't read it, read it. I linked it here in the description. People tend to be risk-averse, meaning that they prefer less than more risk. But unless you keep your money in a savings account, even investing in treasury bonds entails risk. So the first point here with the risk is that you must assess a level of risk for a given investment and be able to live with it. The second point is that any investment decision almost always involves a trade-off between risk and potential return. For example, suppose there is a treasury bond and a small cap stock that both can earn you 5% potential return. But everyone knows that treasury bonds are not as risky as a small cap stock. For this reason, investors would start dumping shares of the small cap stock until its potential return reaches a certain level far above 5% with a decline of its stock price.
You have probably seen this graph before called a capital market line. It shows a positive relationship between risk and return. High-risk assets such as stocks should demand higher return compared to treasury bills.
The graph is elegant and simple, but is it missing something? People tend to think that to make higher returns, you just take on more risk. However, you cannot count on risky investments to always produce higher returns. I mean, they're called risky for a reason. Otherwise, if they reliably produced higher returns, they would be anything but risky. So the correct reasoning here is that the risky investments, they promise you a higher return. Notice a word I use, promise. It's a promise and nothing more. And this is what this graph fails to convey.
The dots on the line are expected average returns for a given level of risk. But things seldom go as expected. Instead, think of riskier assets having a wider distribution of returns and their probabilities. Yes, on average, you can expect to make more, but you can also expect to lose more. For instance, in this example, I use treasury bills with expected average return of 4%. Notice how losses and their probabilities are much smaller. Conversely, here's a small cap stock with expected average return of 12%. But note how probability distribution is wider with longer tails. So you can lose more with higher probabilities with stocks compared to treasuries. Howard Marks, in his book The Most Important Thing, modified the capital market line. There, he shows a more accurate relationship between risk and return. Howard does that by incorporating uncertainty in the form of distributions. The graph clearly shows 3 things about riskier assets. They have higher expected returns, they have higher probability of lower returns. They can even generate losses.
So there's not only positive relationship between risk and returns, you also have an uncertainty of returns and a possibility of loss. Moreover, the possibility of investment loss goes up as you take on more risk. Now, why investment risk is not a volatility? According to Howard Marks, many theoretical models equate volatility to risk out of convenience. It has nothing to do with reality. Academicians think that the variability of returns is what makes them risky. So, for a given asset with higher levels of volatility, it should demand higher returns. But as Howard Marks points out, this is not how the market sets prices for assets. You are unlikely to meet someone on the Wall Street demanding higher returns for an asset that fluctuates more. If investment earns more for a given level of probability of a permanent loss of capital, a typical investor would ignore volatility. Moreover, volatility is a historical metric and says nothing about the future, and seldom any value is added by extrapolating history. However, there are many other forms of risks that could be important for some investors. They are specific to one's circumstances, and they do not reflect what the overall market cares about. For instance, let's come back to volatility. Suppose that I'm retired and I rely on sales proceeds from my portfolio to pay my monthly bills. And let's suppose my entire portfolio consists of Tesla stock, which is very volatile. Let's suppose also that my cost basis is $200, and recently the stock price declined to $100. And let's say this month I need to sell Tesla shares to pay my monthly bill, and there's nothing I can do other than to sell. And if I do, I will lock in a permanent loss of capital. But if I can wait out this dip and not sell Tesla stocks, I won't realize this permanent loss of capital. So as you can see, volatility is sort of important for someone with specific needs, such as selling shares to pay monthly bills. But objectively speaking, it's not really relevant for a typical investor who can wait out dips in stock prices. Another example of subjective risk is illiquidity. If you are someone who may have sudden cash needs in the next 1 or 2, 3 months, you really shouldn't invest in illiquid real estate, for instance, that can take months to sell. Instead, you would really invest in stocks and bonds with high levels of liquidity. Thus, illiquidity may become important for you under certain circumstances. But again, it's not a risk for a typical investor. An average investor doesn't care about getting stuck with investment that takes months to sell. He would be okay as long as this investment offers attractive return for a given probability of a permanent loss of capital. So how do you measure risk as a probability of a permanent loss of capital? In reality, you cannot. There's no single number or a distribution that you can construct. As we just covered, riskier investments, they have high uncertainty and a wider distribution graph. But in reality, nobody really knows how this graph looks. It could be a normal distribution, or it could be something like this with a fatter tails, or it could be skewed. Really, nobody really knows. Many investors rely on the past to make their judgments. But history is full of freakish events that nobody thought of. They were thought of as impossible or very unlikely. But unfortunately, these black swan events, they happen, and they happen very often. Just take COVID-19. Nobody thought that governments would shut down the entire economies and force everyone to sit at home. Or, for instance, the real estate bubble that caused the great financial problems in 2007-2008. Everyone thought that the real estate market is unsinkable. That was the conventional wisdom. But we know what happened with that line of thinking. Moreover, if investment did very well, it still could have come along with a great amount of risk that just simply didn't materialize. It's sort of invisible, even in retrospect. Let me give you an example. Consider Tesla back in 2012. The company just released Model S, and it was fraught with bugs and performance issues. And the company faced really bad crunch with respect to cash, because there were not many sales. And they were so bad that the company had only 2 weeks of cash on hand to cover its wages. The bankruptcy was imminent, and Elon Musk even asked Google and had a verbal agreement with Larry Page to buy out Tesla for $6 billion. Luckily for Tesla, Musk pushed its salespeople to make cold calls to prospective customers, and miraculously sales reps convinced those customers to make the initial deposits on Model S, and Tesla got its money. So this cold calling saved Tesla from bankruptcy or a forced fire sale. But if this cold calling flopped, the history would have been completely different. And these details actually emerged much later in the biography book on Elon Musk. So I wonder what kind of other hidden risks that we do not know about. Value investors recognize that risk comes from high prices caused by excessive optimism and a lack of skepticism. Even a fundamentally broken company can be a great investment at the right price. So it's very important to know when that price is right. Take, for instance, life insurance companies, which are the most conservatively managed companies. But how can this be so, since life for all people ends at some point? The trick comes down to the following 4 aspects. First, you must know your risk. Life insurance companies know that life ends at some point, and they take this into account. Second, it must be a risk that you can analyze. Unsurprisingly, life insurance companies employ doctors and AI to assess their applicants' health. The third point is that risk should be diversified. In case of life insurance companies, they write their insurance policies to a wide variety of applicants by age, location, occupation, or gender. Also, these life insurance policies, they exclude low probability events that can cause widespread losses. These include acts of war or terrorism. Finally, the risk must be such that you are well paid for. Life insurance companies take all these things into account and set their premiums to make a profit on an average person whose life expectancy conforms to the actuarial tables. Thus, these 4 points are most important aspects for recognizing, dealing with, and controlling for investment risk. I hope you learned something new today, and if you did, please give this video a like and subscribe to my channel for more content on investing. Thank you for watching.